It's about lunchtime, isn't it?
Okay, let's finish this thing up, shall we? Yeah. Let's get it out of our lives. Okie doke. So we'll start out talking about dividends and distributions. So corporations, as we mentioned, have shareholders. The owners are shareholders. And so their forms of distributions and dividends are a little bit different. So to the extent that the distributions or anything that is taken out are from the earnings and profits of the corporation, so the retained earnings, essentially, the distribution is considered to be a dividend. Again, as I mentioned, dividends are not deductible to corporations. They don't get any tax benefit from paying dividends. The benefit is that their shareholders will remain their shareholders and maybe they'll attract more shareholders, right? It's just a way for them to distribute earnings to the owners of the company. So if, though, as I mentioned here, so the E&P, earnings and profits, conceptually similar to retained earnings, but you calculate it using tax calculations rather than financial accounting. Any distribution that is paid in excess of earnings and profits are not taxable to the extent of the shareholder's basis. So if they've got basis in their stock and it's up to that amount, then it's still not taxable to them. Any amount, it's considered a return of capital, a return of what they invested in the company. Any amount over than that, over and above that though, is considered to be a capital gain. So we don't calculate the earnings and profits. We don't do any of that sort of stuff in this chapter, thank goodness. But because it can be a little bit tricky trying to figure that out. But the company, it would be up to the company to determine, to let the shareholders know that the distribution that they're receiving was in excess of earnings and profits. So, essentially that would mean they're giving out borrowed money, kind of, it's money that's not from those retained earnings. A distribution of property that's not cash, that has a basis less than the fair market value, so anything that is appreciated, the corporation is treated as though they sold the property at its fair market value. So the corporation then would recognize a gain on the distribution of that appreciated property. So if they distribute a building that has a fair market value of $200,000, but the basis of that building to them was $100,000, then they're going to have to recognize a gain of $100,000 on that distribution. Example here, Sasha received $500 cash distribution, dividend. Oh, that's not a very good example. That's a really simple example. Now, Sasha's distribution was in the form of property, fair market value $500, basis of $400. The company is going to record a $100 gain, the basis and then Sasha is going to report a dividend of $500, and then her basis in that property is $500 as well, because she's already paid cash on that. Here's another example, Quad Company. Earnings and profits of $5,000, they make a $6,000 cash distribution, so that's in excess of their earnings and profits. They have a basis, Quincy has a basis in the stock of at least $1,000. In this case, he's gonna have a $5,000 dividend, and then a non-taxable distribution, or return of capital of $1,000, and then it reduces the basis of his remaining stock by $1,000 to do that. Another example, same facts, but his stock basis is $200. So he doesn't have basis to absorb that $1,000 in excess. So we've got a dividend of $5,000, non-taxable return of capital of $200, and then a capital gain of $800 on that distribution. And then the basis of his stock is going to be reduced to zero because of that distribution. let's see. What are they saying here? All right, so for disproportionate distributions, so corporations can make a non-pro rata distribution. So this is where it's not based on how much stock is owned. So it's not equally distributed based on the stock. If one or more shareholders receive a distribution that is not in proportion to their ownership percentage, if the distribution in this case is in the form of appreciated property, the corporation is still deemed to have a sale based on fair market value. The shareholder is going to report dividend income then equal to the fair market value of the property received as well. So that's a little bit different because it's a non-proportional distribution. So if a shareholder receives a distribution in full liquidation of their ownership interest, so they sell their shares back to the company, the shareholder is going to have a capital gain or loss equal to the difference between the fair market value and the basis of their stock. So just as though they sell it to somebody else, if they sell it back to the company, same sort of thing, depending upon how much that stock sells for, what the fair market value is, then they're going to have a gain or a loss based on that. Liquidation. So a corporate liquidation, here we're talking about the corporation decides to no longer function. If it's winding up its business, they pay debts and distribute the remaining assets to shareholders. If it's a complete liquidation, the corporation will record all assets and liabilities at fair market value. And the shareholder, if they're getting a distribution, will report a capital gain or loss equal to the difference between their basis and the fair market value, as though it was sold. Now, if it's a liquidation, chances are they're going to have some sort of loss rather than a gain. But here we've got Tara received cash of $5,000 and other assets with a fair market value of $7,000 as a result of the complete liquidation of Blue Corporation. Her basis in the stock was $10,000. She is going to report a return of capital of $10,000. That was her initial investment. Again, that's just sort of like taking money out of the savings account that you already had. But then she got $2,000 value in addition to that. So then she's going to have a capital gain of the additional $2,000. Okay. Any questions on that stuff?